Hi everyone. So welcome to the live stream today. We are going to be doing the interpretation of financial statements part 2 today. So if you are just joining the broadcast, comment below with any questions you have and then share the video as well to invite your colleagues, your friends that you know must join this stream as well so that we get it going. I'm doing the part 2 of this masterclass. I'm very much excited about it, and I know that it's going to be a masterclass that will top up and round up for us for our financial reporting or corporate reporting or advanced financial reporting or strategic business reporting or SBR, whatever it is that you're writing. This is a very critical aspect of the syllabus. So comment below with any questions you have for me, and then let's see how it goes. So let me just open this app. Welcome to the stream. If you're just joining, comment below with any questions you have and share the video as well with your colleagues. Invite your colleagues. Let's join together and let's take this together. I'm doing the part 2 of the interpretation of financial statements to assist you to prepare well for your examination. Okay. So you comment below with your questions. Just put in that in the chat box real quick. All right, so if you're just joining the stream, welcome to the stream. It's the part 2 of the interpretation of the financial statements. Very much excited for having you once again. I've been trying as much as possible to do the part 2 of this since 3 days ago, I think, so that we did the part 1, but I've not been allowed. But today I'm going to be doing that to help you to understand the concept. So let's go quickly into the stream for the day. Right, so we started with a part 1 of the interpretation of financial statements, and in case you did not watch the part 1 of the interpretation of financial statement, I'm going to link that in the icon there. You can click on it, or in the description box you're going to be looking at that, or maybe in the comment box as well. I'm going to be putting it there in relation to that for you to watch the part 1, because in the part 1 I gave an overview of financial performance of an organization, and we discussed the issue in relation to and we discussed the issues in relation to how we can assess the performance of an organization. Now, if you remember closely what we did in that discussion, we spoke about the fact that there are 4 categorization for the interpretation of financial statement, and I made mention of the fact that sometimes there could be some adjustment that a company or we must do to the financial statements before we undertake the performance of the organization. But a couple of principles I mentioned very well is that number 1, we are going to be using ratios to interpret the organization or the financial statements of the organization. Number 2, I made mention of the fact that ratios are meaningless unless they are compared. Now, compared with what? We said that ratios can be compared with the organization's previous year financial statements or financial ratios, or financial ratios of the industry, or the financial ratios of another company. So number 1, we use ratios to analyze the performance of the organization. Number 2, the ratios are going to be compared with either previous year ratios or industry average or better still, we're going to be using ratios of a similar company. Then the third thing I said was that in order to enhance the comparison, the same accounting policies must be used in the preparation and presentation of financial statements. So for instance, if we are assessing our performance and we are comparing our ratios with the ratios of a similar company, we should be using similar accounting standards, similar accounting policies, similar IFRSs and IASs in order for us to comfortably assess the performance of the organization. So these are a couple of principles that we mentioned when we started with the part one of this discussion in relation to that. Then from there, we mentioned that there are four categorization of the ratios. We spoke about the profitability ratios. We spoke about liquidity and working capital ratios. We spoke about the issue in relation to is it gearing or jeering, depending on the school you attended and the teacher who taught you phonics. And then the last one is the investors ratios. Now, I spent my time a lot in the part one to explain to you the various things about the profitability ratios, and I remember writing down here on the guiding principles for the interpretation of the financial ratios, and I believe that you understood that very well. That is, if you have already watched the part one of this video. If you have not, then make sure that you watch the part one of this video before you continue with this, so that you can build the understanding up very well in relation to that. And like I said, I'm going to be linking it above here or in the description box or in the comment box as well, so that you can go and watch that in relation to that. So if you're watching and you have any questions for me on whatever, questions on the exams, question on whatever subject and accounting standards, IASs, IFRSs, whatever question you have, just put it in the chat box. I'm going to be teaching, and I'm also going to be reading your comments like the way I do all the time, so that I can help you to answer any questions that you have in relation to that. All right, so I'll be very much excited to hear from you in the comment box or in the chat box, so you can put it down there in relation to that. Now, under profitability ratios, among other things, we spoke about the ROCE, that is the return on capital employed. Then we spoke about net profit margin. We spoke about gross profit margin. We spoke about the assets turnover ratio, and then we spoke about the sales to net working capital. So, what are some of the things we mentioned there? We said the ROCE. I'm just doing a quick revision, then we kickstart again, because it's very important for my explanation today. So, the ROCE simply measures how much profit is generated from every $1 of capital employed. Okay, how much profit is generated from every $1 of capital employed. So the higher the ROCE, the better it is for the company. Then I told you that ROCE is closely connected with the assets turnover ratio. How? Because the assets turnover ratios measures how much sales is generated from every $1 of asset employed. How much sales is generated from every $1 of assets employed? That is the asset turnover. So the higher the asset turnover, also the better it is for the company. Now, if you remember my interpretation guidelines principles that I listed here, I spoke about changes in demand, I spoke about changes in sales, I spoke about changes in cost of sales, I spoke about changes in operating expenses, I spoke about changes in capital employed. Then I said that traditionally and originally, we expect that, for instance, if the asset turnover is going up, it means that the return on capital employed is also supposed to go up, because if we are generating more sales, then definitely we should be making what? More profit. But I made mention of the fact that there are things that will happen in some circumstances, in some conditions, where an entity is not able to generate as much profit as it has generated sales. And I said that there could be an inverse relationship between the asset turnover ratio and then the return on capital employed. And we mentioned and we discussed the reasons, the causes of that, and I think there were a lot of questions. Samuel Kwasin asked some questions about that, and I clarified it. Wagongo also made a couple of comments about that, and other comments also came, and I addressed all of that in my explanation of the profitability profitability ratio. So if you missed that video, or maybe you watched that video once, go and watch it again, and then make sure you understand the concept in the profitability ratio, because I am coming to look at the liquidity ratio, look at the gearing ratio, and look at the investors ratio today. But I'm going to be making a lot of references to the profitability ratio again to bring the interrelationship, because if you remember what I said earlier, or in the part 1, I mentioned that interpretation of financial statement is not just about the computation of the ratios, neither is it just about writing down English about the ratio you've computed, but the interconnectedness between the two is what is critical, and that is what you must look out for in relation to that. So let me quickly open my slide on this real quick so that we can get going. Right, is it here? I'm not sure you were here. Okay, so I got my slide now. Let's get going. Now, so let's move on with our discussion today, and let's start with the liquidity ratios. If you have any questions in the comment box, I'll be very much excited to read your comments today. So let's go to the liquidity ratios. Liquidity ratios. Now remember what I told you about the liquidity ratios. I told you that it's about assessing the entity's ability to pay its short-term debt as and when what they fall due. So the ability of the organization to pay its short-term debt as and when they fall due is what we mean by the liquidity ratios. Now, not only that, I told you that the liquidity ratios are closely linked with the working capital ratios, right? So let me see if we can get this bit to the back. Okay, it's quite better now. So I wanted to see my face a little bit. So in as much as we're looking at the liquidity ratios, along with the liquidity ratios, we also have to discuss the issue about the working capital ratios. So how do we go about this? You see, the main reason why companies fail is not necessarily because they are not generating more sales. It's not necessarily because they are incurring more expenses, but one of the main reasons why companies fail is because of poor cash management. So it's not necessarily about profitability, rather it's about poor cash management. It is for that reason why it is very important for us to assess the liquidity status of the organization. Now, when it comes to liquidity ratios, there are a couple of traditional ratios that we're going to be computing here. And the first one is the current ratio. The current ratio. Now, the current ratio simply looks at Uche Ijeu. I think I see a comment from Uche Ijeu. Let me see that real quick. If you can reply to that real quick. What's the comment? Let me see. Just go to my channel page here so I can read a comment. Okay, Uche, are you just starting? Yes, almost starting. You can see from the stream 14 minutes ago. I started about 14 minutes ago, but I was talking about what we did in the part 1. So we are now getting into today's business for real. So you are not too late. Okay, Uche, you are not too late. Comment below with any questions you have for me. Let me help you. Let me answer your questions for you, because I want you to pass your financial reporting exams. I want you to pass your corporate reporting exams. I want you to pass your SBR examination. I want you to pass your advanced financial reporting exams. So comment below with any questions you have. I'm going to be answering all of that. So the current ratio looks at the ratio of the current assets to the current liability. So what is the ratio of the current assets to the current liability? That is what we mean by the current ratio. Now, why is this ratio important and why must we look at it? Like I told you earlier, this simply measures the ability of the firm to pay its short-term debt as and when they fall due. What does that mean? So if as a company we have current assets, now you know what current asset is made up of, right? What are current assets made up of? Inventory, cash, bank, debtors, okay, prepaid expenses, all right, income owing. All of these things are the components of current assets. Then what are current liabilities? Current liabilities could be trade payables, could be income prepaid, could be bank overdraft. All of that is current liability. So the question we are asking about a current ratio is, okay, those short-term debts, the trade payables, the bank overdrafts, the expenses owings, the income owings or income prepaid, if we are to pay them today, can we really pay them? That is what the current ratio assesses. If we are to pay them today, right now, can we really pay them? That is the current ratio, and that is what it is talking about. So the company's ability to meet its short-term debt as and when they fall due. Now, ideally, it is required that an entity should have a current ratio greater than 1. Listen to me carefully. Ideally, it is required that an entity should have a current ratio greater than what? 1. An entity should have a current ratio greater than 1. Ideally, that is what we expect organizations to have. But this is the sweet spot. The current ratio that is computed has inside what is called inventory. However, you see, we need to find out how can we change our current assets and pay the debt as and when they fall due. But sometimes it is very hard to convert inventory into cash in the short term. It is hard to convert inventory to cash in the short term. So a more preferable approach in order to assess the liquidity of the organization is to calculate another ratio, which is called the quick ratio or the acid test ratio. So acid test or the quick ratio. Technically, this has the same concept, only that we're going to have current assets, okay, minus the inventory divided by current liabilities. Okay, the same idea. So current assets minus inventory divided by the current liability. So it is preferable to rather use the quick ratio or the acid test ratio to assess the liquidity status of an organization rather than what? The current ratio. Why is it preferable? Because like I said, inventory takes a longer time to be converted into cash in the short term. It takes longer time to convert inventory into cash in the short term. That is why entities prefer to use what? Or that is why they prefer to use the acid test ratio. So let me give you some guidelines. Again, ideally, it should be greater than 1. Please note, when you are interpreting your quick ratios and your acid test ratio, your knowledge of changes in revenue, changes in cost, your knowledge of asset turnover could be feeding into this. And I'm going to be going there in a moment. Still talking about the liquidity ratios, then we come to the working capital ratios because I told you they are alongside. So the next one is the inventory holding period. The inventory holding, or what is sometimes called the inventory turnover period. Now, what is the inventory turnover period? The inventory turnover period simply measures how long it takes an entity to buy and sell inventories. How long it takes an entity to buy and sell inventory. In other words, the longer the inventory holding period, the worse it is for the company. And the shorter the inventory holding period, the better it is for the company. Remember, I spoke about this in the introduction. When we're doing the part 1, I mentioned this very well. And that is where we come in here. So what do we have? This is going to be the inventory over cost of sales times 365. Your inventory over cost of sales times 365 days. 365 days. So remember what I said, how long it takes an entity to buy and sell the inventories. So if there are inventories we've bought and we are taking 50 days to sell them, and there are other inventories we are taking 10 days to sell them, that means the one that is taking 50 days, we are actually locking up capital. But again, when you are interpreting these things, you've got to be careful and take into consideration the industry that a company is in. Certainly, there are some industries that the holding period will be higher, but it is normal for the industry. For instance, if you're a real estate company and we build houses and we sell the houses, then the houses become what? The inventory. So our stock becomes the inventory. Now you know that houses don't get sale, we don't sell the houses in the shortest possible time. Sometimes it can be 2 years. Just yesterday I was actually looking at a house in the Beverly Hills for $89 million, and the house has been on the market for about 9 years now. 9 years. And the house has been on the market because nobody is ready to spend $89 million for such a house. So that is the inventory holding period. Now, so for a real estate company like that, it may have a longer inventory holding period, but that does not mean it's not a good thing for the company, because that is the nature of such organizations. But if it is a real retail company, a retail shop, then we expect that the inventory holding period should be reasonably low. Because imagine you're a retail company, you buy inventories and it takes 100 days to sell them out. That's too much. You're locking up capital too much. Retail, you should buy and it should go. So the shorter the period in that case is better. Now, in either case, irrespective of the industry we are in, whether we are in the retail, whether we are in the real estate industry or real estate industry, the shorter the inventory holding period, the better it is for the company. So like the illustration I gave you earlier, the house, $89 million, has been on the market for 9 or 8 years, so 8 or 9 years. Can you imagine how much maintenance costs they have been paying on that building, on that house? All its cost and capital has been locked up to build that house, and 8 or 9 years it is still sitting down there. So it's not a good thing. But if we build the house and we sell it in the shortest possible time, then it could be a good news for the company. But the big question we then ask ourselves is, now, you see, I'm giving you the interpretation of, and that's where you have to catch very well. The next question you need to ask yourself is, why is the inventory taking longer to be sold? Why do we have a high inventory turnover? Did I say high? Yes, high inventory turnover. Why is it taking us a long time to pay for to sell the inventory? Number one, it could be because of the increase in the price of the organization. So changes in price. Very, very important, because if the organization undertakes a discount promotion and do buy one get one free, then the inventory turnover is going to be what? Low, or the inventory holding period is actually going to be low at the end of the day. Or if the organization decides to increase the prices of the goods, then certainly the inventory holding period is going to be high. So it could be because of what? Price changes. Another thing could be because of the nature of the commodity. Maybe the commodity that we are selling is seasonal. Like for instance, if you are selling cardigans or pullovers, you know, especially in Africa here, hardly do people wear that. People only wear that in the raining season. Even in that, only some few people actually wear it. So we will actually start selling in such seasons. But as far as it's not really a raining season, the rest of the year is the sun is scorching, then people are not going to be buying. So the nature of the commodity will also, I wrote company here. Can you imagine that? The nature of the commodity could also affect what? Our inventory holding period. So if we are doing the interpretation, we must look at what commodity does the company sell, and that will always be in the preamble of the question for us. Then what I mentioned, the industry that we are dealing with. The industry that we are dealing with, because that is how we will be able to determine whether the inventory days, if it is increasing, is a good news for the company, or if it is reducing, it's a bad news for the company in relation to that. So 3 core things you must take into consideration: the changes in the price of the product, the nature of the commodity involved, and then the industry that a company or the organization is in. That is what we mean by the inventory holding period. So current ratio, quick ratio. Now remember, I've not really come to the interpretation of these guys yet, because I'm going to be linking them with the trade payable days, trade receivable days, asset turnover in a moment. So you make sure you stay with me. If you have any questions, please put them in the comment box. I'll be very much excited to answer that for you in relation to that. So let's go to the last 2, I guess. Trade payable days and then trade receivable days. So next one, trade receivable days. Now, what does the trade receivable days measure? What does it measure? The trade receivable days measures how long it takes an entity to collect cash from credit customers. Again, the shorter the trade receivable days, the better it is for the company. The shorter the trade receivable days, the better it is for the company. So how do we compute this? We compute this by looking at the receivables. Trade receivables, all right, divided by the sales, or other books will call it turnover, times 365 days. Times 365 days. How long it takes our customers, our credit customers, to pay us the money they owe us. The longer the period, the worse it is for the company. The shorter the period, the better it is for the company. I'm going to come back to this in a moment. Then we go to the trade payable days. That's the reverse of this. How long the organization takes to pay its suppliers. How long the organization takes to pay its suppliers. And that's going to be trade payables over cost of sales. If there is purchases inside, we will use purchases times 365. Sometimes if there is credit sales in the question, we may want to use the credit sales in relation to that. So how long it takes an entity to pay its creditors. Now, this is the sweet spot. This is the sweet spot. With the trade receivable days, the shorter the days, the better it is for the company. The longer the days, the worse it is for the company. But with the trade payable days, what happens is that the longer the trade payable days, the better it is for the company, because trade payable is actually a short-term source of finance to the organization. So if I owe you and I don't pay you the money I owe you, and I use that money to do something else, it's a good thing to me. However, even though the trade payable days being long is good to the organization, it's better for the organization, it could also have some disadvantages. Why could it have some disadvantages? Number one, if we take longer to pay for the people we owe, we may be losing discounts, early settlement discounts. So maybe there are early settlement discounts that we are supposed to have, but if we don't pay them, we won't get the benefits of what? The early settlement discount. So we're going to be losing early settlement discount. So for those of you who did financial management, or who are going to be doing financial management, one of the things you're going to be doing is the management of trade payables, and you have to assess the discount and borrowing money, which one will be better, or the discount and delaying, which one will be better. So we're going to be looking at that, but we're going to be losing discounts. Number two, we're going to be losing goodwill. Our name will be tarnished in the books of the supplier, because the supplier will actually blacklist us and say we don't pay early. We are not a good customer. We are not a good customers. We are not a best fit for them as an organization. When that happens, it means that we are going to be losing future, so loss of future credit. Now, if I sell to you and I told you to pay me in a month's time, and you actually pay me in 3 or 4 months' time, do you think next time I'll sell to you? Never. Never. I'm not gonna sell to you. Why? You're gonna be losing what? The future sales. So this is where the company must be careful when it is trading. The company must be careful, because in as much as the longer the trade payable days, it is good for the company. We as the analyst, we must tell the company that, hey, you may be losing discounts. Not only that, you may be losing future credits. They may not be willing to sell to you. So if we are doing the analysis and we realize that year 1, trade payable days was maybe 18 days. Then the current year, year 2, the trade payable days has gone to 52 days. It is good. We will interpret that it is good, meaning the company is using their money to do something else. However, we must tell the company the implication of the increase in the trade payable days, that they may lose early settlement discounts, they may lose goodwill, and they will definitely lose what? Future credit from the organization. I believe you are getting the concept. This is very, very important. Okay, this is what you do when you're interpreting the financial statement. Like I told you last week, you don't just say, the thing has increased from 18 to 52. It means that the company, no. We don't want to hear you saying just that. Tell us about, yes, it has increased. What is the percentage increase? Like I did in the part 1. What is the percentage increase? What is the causes of that? And what are the possible implications of that? And that's what we're going to be looking at here. Very, very important. Again, when it comes to the trade receivable days, remember what I told you. The less or the shorter the period, the better it is for the company. The shorter the period, the better it is for the company. However, if the trade receivable days are short, there are also some disadvantages that we may be having. There are some customers who cannot pay us within a month, but they want to buy more. So we may also be losing what? Some sales from such customers. So if we say everybody should pay in 1 month, but somebody can pay in 2 months, but the person will buy maybe 4 times of what everybody is buying, then we may lose what? That customer. Now, that doesn't also mean that we will be laissez-faire about our sales and allow people to take the money away anytime they like. But we need to assess and look at that and look at the credit worthiness of the customer and find out. But this is the big deal. If the asset turnover of the organization, please listen to me carefully. Listen to this carefully. If the asset turnover of the organization is increasing, listen to me carefully. If the asset turnover of the organization is increasing, what does that mean? It means we are generating more revenue from the utilization of what? Every $1 of assets. Now, if your asset turnover is increasing and your trade receivable days is also increasing, it could mean that the entity was selling goods on credit. Did you hear that? If your asset turnover the asset turnover, it's increasing, then at the same time, your trade receivable days is also increasing. What it means is that trade receivables during the year has increased. The reason being that the sales during the year has been a credit sales. So that is why the company had a high asset turnover. So the high asset turnover, yes, we sold, but majority of the sales was on credit. If, however, the asset turnover is increasing, but the trade receivable days is falling, what it means then is that, yes, the entity has increased its sales, but the sales has been more or less like a cash sales rather than a credit sales. Or it could mean that the entity gave discounts or did a price reduction, so people bought more either in cash or they bought more on credit, but because of the discounts, the credit component is down. So it's very, very important for you to be able to understand the concept in relation to that. So if you have any questions, please put them in the chat box for me. Or in the comment box for me. I'm going to be answering all of your questions as well in relation to that. So that is the trade receivable days, trade payable days, and like I mentioned earlier, the inventory turnover or the inventory holding period or days. I believe you get a concept there. So I haven't understood. So these are some of the things we do under the liquidity ratios. Please remember how I merge the interpretations. It's very, very important, and it's very, very critical in relation to that. So let's move on to the next one, gearing. Gearing or gearing, depending on the school you attended, like I said, or the teacher who taught you phonics. Maybe you went to some school that nobody knows about her. So let's go, the gearing ratios. Gearing or gearing ratios. Now, so like we mentioned this earlier, we said that the gearing has to do with assessing the long-term liquidity of the company, the long-term solvency of the company. That is, the ability of the company to pay its long-term debt as and when they fall due. The ability of the company to pay its long-term debt as and when they fall due. Now, the gearing ratio not only assesses that, the ability of the company to pay its long-term debtors and when they fall due, but it also looks at the capital structure of the organization. Now remember, anytime you're talking about gearing ratio, one of the things that must come into your mind is interest. So in addition to the computation of the gearing ratio, we're going to be looking at what we call the interest cover ratio. That is, we want to find out how much profit is the company making as compared to the interest that the company is going to be paying. So let's get into it real quick in relation to that. Let me not drink the soup out of the fufu. So gearing could be calculated as your debt over your equity times 100. Or other time, it could be debt over capital employed times 100. So either debt over equity or debt over capital employed. Again, preferably, the second approach is better, where we look at the ratio of the debt to the capital employed of the company. And I know you know what capital employed is. I told you there are two ways capital employed can be calculated. Capital employed could either be the total assets minus current liabilities, or your shareholders fund plus long-term debt. Okay, shareholders fund plus long-term debts. And we said shareholders fund includes stated capital, share premium, retained earnings, reserves, revaluation surplus. All of those things is shareholders fund, plus the long-term debt gives us the capital employed. So that is how we calculate the gearing. Now, a higher gearing ratio indicates that the company is heavily in debt. Let me take that again. A higher gearing ratio indicates that the company is heavily in debt. But again, like I told you earlier in my introduction, the fact that a company has a higher gearing ratio does not mean the company is on the path of how do we call it? On the path of destruction. Does not mean the company is on the path of bankruptcy. Yes, the company can be highly geared, but if it is making profits and is able to make profits more than how much interest is supposed to pay, then to some extent we can say, oh, the company is working well. So in order to assist us to conclude whether the gearing ratio is too high or too low, it's too high, because if it is low, it's okay. But in order for us to assess whether the gearing ratio, wow, whoa, Now, guess what? ECG just took our lights in relation to that. But I think I have some level of brightness. I don't know if I can continue. Let me continue like that. Okay, let me continue like that in this level of brightness that is quite less. But let me continue like that and explain the concept at the end of the day, because I don't want to shoot this in another session. I want to do something else. So, like I was saying before I went off, or the light went off, the fact that the gearing ratio is high may not indicate that the organization is heading towards bankruptcy, or the organization is not making money. That could not be the reason. So in order for us to confirm whether the organization is doing well or is not doing well, in order for us to confirm that, we have to calculate a third thing here, and that is going to be the interest cover ratio. The interest cover ratio. So let me put that here. Interest cover ratio. So the interest cover measures, hope you can see, interest cover, and this is going to be the operating profit, or if you want, profit before interest and tax divided by the interest expense. Profit before interest and tax divided by the interest expense. Now, what does this mean? What does this mean technically? What does this mean? This simply means that how much profit are we making before interest and tax as compared to the interest that we are supposed to pay. So for instance, if we are making a profit of say $200 and we have to pay an interest of say $420, that means we are highly geared. It means the organization is not in a good position. It means we are not a profitable company. So this is how we determine whether the gearing is good for the company or the gearing is bad for the company. So if we make a profit of 200 and we are supposed to pay an interest of 420, then that is not good for the company. But look at the flip side. If the organization is geared and we make a profit of say 420 and the interest expenses we are supposed to pay is just something like 110, then in this case, the interest cover is like 3 point something. For that reason, it is a good thing for the organization. So when the gearing is high, we don't just say, oh, it is not good. Oh, this company has to file for bankruptcy. Oh, this company is going to die soon. Oh, this company is not going to do well. No, we don't say that. Before we say that, we have to decide and we have to calculate what? The interest cover ratio. That is, it measures how much profit we are making before interest and tax, before charging okay, so my light is in. I'm going to be continuing. Right, so like I was saying, we don't just compute a gearing and say it's too high or it's not good for the company. When we compute the gearing, we need to ask ourselves, what is the interest cover? If our interest cover is high enough, that means it is good for what? The organization. So even though we may calculate the gearing, which will be 70%, so maybe year one, gearing was 25%. Then in the current year, when we calculate the gearing ratio, it is say 75%. Then we say, whew, this thing has increased by 300% or something like that, or yes, 200%. We don't just say it's bad, it's too high. No, before we say that, we must come and calculate what? The interest cover. If the interest cover is more than 1, then it means that, yeah, the company may be highly geared, but the company is making profit. So as far as the company is highly geared and is making enough profit before interest and tax, boom, then we are good to go in relation to that. So that is also how we interpret our gearing ratio. Okay, so remember, you don't just interpret the gearing ratio in the light of the gearing ratio you've calculated or you've computed. Rather, you interpret the gearing ratio in the light of the interest cover. So the interest cover will guide you in relation to that. Now, look at another relationship I'm about to draw here. Very, very important. Look at another relationship I'm about to draw here. If your ROCE fell, return on capital employed fell during the year, however, your asset turnover was increasing, then what could it mean? What could it mean? Like I mentioned, maybe it's because our debt is what? Going up. Now, if our debt is going up, what happens to the ROCE? The ROCE is going to fall. All right? The ROCE is going to fall. Now, if ROCE is falling, that means that we have to look at the interest cover and then we interpret it in the light of that. So that's another relationship. One way you can relate the ROCE to the gearing is to find out the relationship between the gearing and then the ROCE and then the asset turnover. That connectivity is very, very important, and that is what shows that you understand ratios very well in relation to that. Then let's come to the last ones. Now we've dealt with the profitability, we've looked at the liquidity and working capital. Let's look at the final aspect, and that it's going to be the issue in relation to what? The investors ratio. The investors ratio. So at the end of the day, investors will also want to assess how much they are going to be making. Remember, I told you in the introduction that the investors want to assess and find out how much they are going to be making at the end of the year. Okay, so the investors ratio. The first investors ratio is the earnings per share. And you know this from IAS 33. Earnings per share. Okay, so your earnings per share is the profit after tax divided by the weighted average number of equity shares. Okay, the profit after tax divided by the weighted average number of equity shares. Now, the earnings per share measures how much profit is attributable to each equity shareholder. How much profit is attributable to each equity shareholder. So, for the year, after we pay interest, after we pay tax, the profit that is left, it is called profit attributable to equity shareholders. That profit attributable to equity shareholders divided by the number of shares the company has, that is what leads us to what? The earnings per share. Again, the higher the earnings per share, the better it is for the company. But if we do our comparison and we realize that the earnings per share is falling, the earnings per share may be falling because of some reasons. Number one, it could mean because there is increase in shares, which means some level of dilution in the shares, or it could be because of reduction in the profit. And when there is a reduction in profits, that means costs could be high or revenue could be low in relation to that. So when your earnings is falling, it's not a good thing, but these are the reasons that it could mean. Now, then the next thing is the dividend per share. Dividend per share, DPS. The dividend per share is just the dividend payable divided by the number of shares. The dividend payable divided by the number of shares. Remember, when I was doing the introduction, I explained this to you. Earnings per share is always greater than dividend per share. Why? Because entities retain profit. The profits they earn during the year, they don't pay 100% out as dividend. So they are going to be retaining some. So because they will retain some, it means the dividend that they will actually pay will be less than the earnings that they had during the year. So that is the concept about dividend per share. How much dividend declared, it's payable to each equity shareholder. But in order for us to assess, like how we did in the jury, when your profit is more than your interest, it means you are a good fit. Shareholders will also assess the profit against the dividend that they are having. What is the fit? So that is what we mean by the dividend cover. The dividend cover. So sometimes your earnings per share may be falling, but the dividend cover may be still positive, maybe still more than one. In that case, there is no issue for us in relation to that. So that would be net profit divided by the dividend that we are paying. So if the company has a dividend cover that is decreasing, it's indicating that the organization is increasing in the risk and is not able to pay dividend to the shareholders. Okay? So if your dividend cover is decreasing, it could mean that the organization is in risk and having some financial problem, is not able to pay more dividend to the organization or to the shareholders in relation to that. But remember, the fact that a company is not paying dividend does not mean the company is not a good fit. Because if they don't pay dividend and they retain the money and they use the money to undertake other projects, then it will increase the shares of the company. However, if they are not making more profit, but they are paying more dividend to us, then that is not good for us. That is not good for us as an organization in relation to that. Then there are some other shareholder things like the dividend yield, DY. And that's going to be the dividend per share, DPS, dividend per share, over the share price, SP, times 100. The dividend yield has to do with how much returns shareholders are making on the shares that they have bought in the company. How much returns they are making for the shares that they are owning in the company. Again, the higher the dividend yield, a yield means returns, okay? The higher the dividend yield, the better it is for the company. So if, for instance, the share price is, say, $20 per share, and you're making a dividend of, say, $2, is that good? That may not be good. That may not be good. That may not be good. That's 10% returns. And that may not be good. That may not be good, okay? So the higher the dividend yield, the better it is for the company. And then the last one is the EY. That is the earnings yield. And it has the same concept. That is the earnings per share over the share price, also times 100. And this measures the returns that the shareholders are making in relation to the profits of the organization, the returns that the shareholders are making in relation to the profits of the organization. So these are the various ratios that you must understand in relation to dealing with interpretation of financial statements. All right, dealing with interpretation of financial statement. I believe that you get a concept. I believe that you get a principle. I believe that you understand the concept here. Very, very important. Remember, like I said, it's not just about the computation, but rather the interpretation. And I've spent time a lot